Special Reports is a daily show that will cover issues surrounding the economic collapse. All our reports and daily alert news are backed up by source links. We work very hard to bring you the facts, and we research everything before presenting the report. Subscribe for latest on financial crisis, oil price, global economic collapse, dollar collapse, gold, silver, Bitcoin, global reset, new world order, economic collapse, economic news, political, geopolitical news. Today, we talk about 10 years after global financial crisis shook the world economy. How a decade of financial crises changed the world. When asked how he went bankrupt, one of Ernest Hemingway's characters replies, 2 ways. Gradually and then suddenly. That's rather how the crash was for the world. There was an extended build-up, with cracks in the system emerging during the course of 2007. Then there was the sudden shock, when Lehman Brothers collapsed in September 2008, and the global banking system teetered on the edge. The 10th anniversary of that frightening moment approaches. There were some impressive takes from authors in the immediate aftermath of the turmoil, such as Androra Sorkin's Too Big to Fail and Michael Lewis's The Big Short, which was made into an Oscar-winning film. Inside Job, a documentary, was a scathing attack on the culpability of the finance industry for the crisis. And a new adaptation of a 3-part play about the history of Lehman has just opened at the National Theatre in London. Adam Tooze, a historian noted for his works on the interwar period, is aiming to be less entertaining and authoritative. He takes on the financial and economic history of the last decade in a monumental tome of nearly 700 pages. Yet with the events it covers so recent and so dramatic, the book is as much reportage as historical analysis. 4 big themes emerge from Mr. Tooze's account of the post-2008 era. The first was the immediate post-crisis response, in which the banks were rescued, and both the monetary and fiscal taps were loosened. The second was the Eurozone crisis, which hit Greece and Ireland hardest, but also affected Portugal, Italy, and Spain. The third was the shift in the developed world, after 2010, to a more austere fiscal policy. The fourth was the rise of populist politics in Europe and America. Mr. Tooze sides with most economists in taking the view that the immediate post-crisis response was necessary, but unfortunate in that executives in the banking industry paid too low a price for their folly, that Europe was slow and narrow-minded in dealing with the peripheral countries, and that the switch to austerity was a mistake. Taken together, the backlash against bankers, frustration with EU governments, and the impact of austerity led to the rise of populism, the election of Donald Trump, and the Brexit vote. A big part of the problem, as the author points out, was a failure of political leadership. European politicians initially dismissed the crisis as an American problem generated on Wall Street, even though Europe's banks also had balance sheets stuffed with dodgy loans. Meanwhile in America, the Bush administration got its crisis measures through Congress only with support from Democrats, but bipartisanship stopped the moment Barack Obama took office. Perhaps the most dangerous failure, though, lies in the unwillingness to deal with problems which lie at the heart of the system, and persist today. The finance sector, which caused the crisis, looks remarkably unaltered. Banks may now hold more capital, and their bonuses are now tied to longer-term performance. But bonuses are still very high. The average payout on Wall Street last year was $184,220, just shy of the 2006 record. Scandals over banks' bad behavior, in areas such as price fixing, money laundering and mis-selling continued to come to light. Anyone who fell asleep in 2006 and woke up to look at the financial markets today would have no idea there had ever been a crisis. Share prices in America have repeatedly hit new highs, and valuations have been surpassed only in the bubble eras of 1929 and 2000. The interest rates paid by governments and corporations to borrow money are very low by historical standards. In global terms, the amount of debt relative to GDP is about as high as it was before the crisis. As the author points out, it is far from clear that governments will be willing to take decisive action when the next crisis hits. The debate about macroeconomic policy goes on in much the same way as it always has. Those who believe that governments can afford to borrow and spend more are still arguing with those who think that debt is already too high. Those who want central bank policies to return to normal, higher rates, no more purchases of government bonds, are still arguing with those who believe that premature monetary tightening will damage a still fragile economy. The big change has been in the public mood. The idea that markets, left to their own devices, will efficiently and fairly allocate resources had gained adherents in the 1990s and early 2000s. Center-left governments, such as Tony Blair's, were happy to leave the financial markets to get on with it. Now those middle-ground politicians are out of office as voters peel off towards the far left and nationalist right. Even the Republican Party in America has swallowed its free market instincts and is tolerating President Trump's protectionist measures and threatening behavior towards firms he takes against. Many British conservatives have been overtly hostile towards those business leaders who express fears about Brexit. The idea that trade makes everyone better off in the long run is no longer universal. Indeed, Mr. Trump sees it as a zero-sum game. These views are showing up in the numbers. Global trade has stopped growing much faster than GDP, as it did before the crisis. This change of mood raises fears about what will happen when another storm hits the world economy. The level of cooperation that occurred in 2008 and 2009, such as when America's central bank made dollars available to its cash-strapped European counterparts, may not be easy to achieve next time around. Tomorrow's chroniclers will be grateful for Mr. Tusa's assiduous research. He leaves no mortgage-backed security uncovered, no collateralized debt obligation unexamined in his effort to produce the most comprehensive account of this complex and gripping subject. The general reader might find it a bit of a slog. It is not that the author cannot see the wood for the trees, more that the forest is so large and dark that it is easy to get lost. Sometimes the broader themes simply get overshadowed by an account of another round of cliffhanger meetings. Mr. Tusa ends by comparing events today with those in 1914, when the world sleepwalked into conflict. But arguably it is the interwar period that is the most pertinent parallel. The armistice ended the First War, but the tensions that generated the first conflict simmered and finally exploded once more. For policymakers, another deadly metaphor is perhaps more appropriate. Central banks brought a global economic heart attack to an end by performing emergency surgery. But the patient has gone back to his old habits of smoking, heavy drinking, and gorging on fatty foods. He may be looking healthy now, but the next attack could be even more severe, and the medical techniques that worked a decade ago may not be successful a second time. The world trusts less. The 10th anniversary of the height of the international economic crisis, which saw the collapse of Lehman Brothers and other major firms, is fast approaching. A decade on from September 2008, the fact that multiple equity markets are near all-time highs, and the global economy is growing robustly again, is disguising one of the key legacies of the period. For one of the major ramifications of that crisis, considered by many economists to have been the worst since the Great Depression of the 1930s, is growing distrust in business, not least amongst the young. And in turn, this has helped fuel the post-truth phenomenon in which objective facts have become progressively less influential in shaping public opinion than appeals to emotion, by reinforcing a wider collapse of public confidence in major institutions in both the private and public sectors. While growing distrust in business is shown in numerous opinion polls, it is also symbolized by the significant protests since 2008, including the Occupy movement, which came to international prominence in Wall Street in 2011, in its campaign against social and economic inequality. The Occupy demonstrations, often driven by younger people, subsequently spread to around 1,000 cities and more than 80 countries in all continents of the world, from Canada to Norway to New Zealand. Diminished confidence in business has reinforced key drivers of the post-truth era, adding to the broader collapse of trust in major institutions. And while much attention has been focused on the political causes and ramifications of the post-truth phenomenon, not least with the controversy surrounding Donald Trump's White House campaign and subsequent presidency, it has profound implications beyond democratic politics. For business, one of the key challenges of the post-truth age is that belief in what many corporates are saying and doing has been undermined as distrust has grown. This poses new hurdles for firms looking to grow and enhance reputations. In a world where there is already a long-standing and growing backlash against business on issues such as executive pay, through to international trade and globalization. Key ways that businesses can build trust include tried and tested ones of creating good new jobs and investing in the economy while paying workers fair wages and benefits. Yet, beyond this, a growing number of firms are using new thinking and ideas to restore credibility. Diminished confidence in business has reinforced key drivers of the post-truth era, adding to the broader collapse of trust in major institutions. One key feature of the post-truth landscape is that while faith in big institutions and many elites including CEOs and leading politicians has generally been declining, trust in the views of family, friends, and close colleagues who are perceived to have more authenticity and legitimacy is growing. And this trend relates to a second key driver of the post-truth age, with the digital revolution changing the way many of us consume information through social media. Research shows that recommendations from family, friends, and colleagues we know and trust are becoming increasingly influential in shaping opinions and behavior. Well before Trump's shock U.S. presidential election victory in 2016, the political world had been trying to get to grips with these important changes, and corporates are also increasingly seeking to address them too. One way some corporates are harnessing the power of this shift is through empowering new grassroots advocates to help rebuild trust. For instance, employees and supply chain partners have significant credibility and legitimacy as third-party validators, and social media has significantly increased the level of influence that these single persons or organizations can potentially have. Another key feature of the global landscape is founded on the apparent paradox that while there is generally growing distrust in business, many people nonetheless expect the private sector to play a greater role in change in society for the better. This includes helping to tackle the range of grand challenges facing the world, from environmental problems such as climate change to growing economic inequality in many countries and health issues such as the escalating international epidemic of obesity. Of course, many corporates have long had sustainability, social responsibility and/or philanthropic programs to help address such issues. However, the scale of the challenge and potentially opportunity is giving rise to what leading Harvard academic Michael Porter has highlighted as a new way for firms to secure the competitive advantage by creating what he calls shared value for society as well as shareholders. Perhaps the key idea behind this shared value concept is that the corporate competitiveness and the health of society at large can be mutually dependent and reinforcing. Thus, capitalizing on the connections between societal and economic progress can potentially help drive sustainable, inclusive growth and shared prosperity in the years to come, and help firms rebuild legitimacy and trust. Taken overall, the post-truth phenomenon is likely to continue to have profound implications for business just as for democratic politics. A decade on from the international economic crisis, with the loss of faith in big institutions and many elites showing no major signs of rebounding, this means corporates will increasingly need to look for new, innovative ways to rebuild reputation. In another financial crisis we would have far less wiggle room. After the 2008 meltdown, there is limited scope for monetary policy, nations are divided and populism is on the rise. Nobody really knew it at the time, but 10 years ago the world was sitting on the edge of the precipice. It seemed like a normal sleepy August, but the calm was illusory. The global financial system was seizing up. The collapse of Lehman Brothers was but a month away. Eventually policymakers finally understood the enormity of what was happening. They responded swiftly and decisively, as the crisis spread from the banks to the rest of the economy. They needed to. During the winter of 2008-09, trade and industrial production were collapsing more quickly than they had during the Great Depression. Now imagine if something similar were to happen again. It is not the likeliest of outcomes, but not all that far-fetched either. China's debt, Brexit, a global trade conflict, any of them could blow up into something serious. These sort of events form the basis of the war games that policymakers play from time to time. In the winter of 2008-09, action was taken to prevent a deep recession turning into a 1930s-style slump. What's worrying is that it might not be possible to do the same again, at least not by the means used last time. There are at least 4 ways in which policy is more constrained than it was a decade ago. First, and most obviously, there is monetary policy, the options available to central banks. At its August meeting in 2008, the Bank of England left interest rates unchanged at 5%, which meant it had plenty of scope to cut when it finally woke up to the seriousness of the situation. Even after last Thursday's rate rise, official borrowing costs are only 0.75%, providing much less room for maneuver. One of the small comforts from the crisis of 2008-09 was that it generated a sense of international solidarity. Back in the summer of 2008, only economists had heard of quantitative easing, but the term was soon in widespread use after central banks embarked on bond-buying schemes designed to boost the supply of money to their economies. In the event of a crisis, central banks would cut interest rates to zero and resort to more QE, but the law of diminishing returns suggests the impact would be less powerful than in 2008-09. Then there is fiscal policy, tax, and spending decisions made by finance ministries. In Britain, the budget deficit, the gap between what the government spends and what it receives in taxes, expanded rapidly during the crisis from 2% of gross domestic product to a peacetime record of 10% of GDP. It has taken 10 years to bring the deficit back to where it started, and meanwhile national debt as a share of the economy has more than doubled to over 80% of GDP. Despite a prolonged austerity drive set to continue well into the next decade, the public finances are in worse shape, and they were when Lehman's went bust. One of the small comforts from the crisis of 2008-09 was that it generated a sense of international solidarity, because the world's biggest economies quickly realized they need to help each other. There was a collective commitment to shore up banks, the creation of a new body, the G20, to bring together developed and emerging market economies, as well as an agreement to refrain from protectionism. As Adam Tooze notes in his new book about the crisis crashed, the U.S. Federal Reserve quietly acted as the lender of last resort to Europe's troubled banks. The collaborative mood did not last for long. Europe and the U.S. went their separate ways over austerity. The G20 failed to live up to its early promise, and even before the arrival of Donald Trump in the White House, countries had quietly been finding ways to defend the interests of domestic producers. Trump has, of course, taken isolationism to a whole new level by picking trade fights not only with China, but with the EU, Canada, and Mexico as well. In the current beggar-my-neighbor environment, the chances of the world coming together in the event of a new crisis appear slim. There is one other significant difference between now and a decade ago: the political climate. The last crisis came at the end of a prolonged upswing, in which wages and living standards rose steadily. Britain went 16 years without a single quarter of falling output, and in the latter part of this period, when Labour was in power, there was bountiful investment in the public sector. Feast has been replaced by famine. Wage rises have turned into pay freezes, living standards have stagnated, and the public sector bears the scars of a decade of cuts. Austerity fatigue has set in, making it nigh on impossible for governments to insist that voters endure a new round of sacrifices. The public mood is already sour. To summarize, the scope for monetary policy is limited, finance ministries are wary of borrowing more, the international community is riven, and populism is on the rise almost everywhere. So what options are there? Initially, the response will be more of the same. Monetary and fiscal policy will be eased to the extent that it can be. But if that does not work, more radical ideas will be canvassed, including reducing the size of the state, negative interest rates, a more targeted form of QE to fund infrastructure, and tax cuts financed by the printing of money. None of this is currently in prospect. Yet back in August 2008, the Bank of England thought growth would be flat over the coming year if interest rates were kept at 5%. There was no suggestion that 6 months later interest rates would be 0.5%, QE unveiled, and an emergency VAT cut announced. The lesson of 2008 is that in a crisis the impossible can become possible very quickly. Thanks for watching. Tell us what you think in the comments section below.